Every day, every single day, things are happening in the world of deals and deal makers. And there's never enough time to keep up with every company, transaction, announcement, or whatever. It's just exhausting. And we have a new product to help fix that. This is Axios Pro Deals, a new premium subscription product bringing you tailor-made insights like never before. For the last 5 years, Axios has helped deal professionals navigate the whole deal landscape with Pro Rata. With Axios Pro Deals, we're diving deeper into the industries that matter most to you. You just want stories on fintech? There's a newsletter for that. MedTech deals? We've got you covered. The future of retail? We'll guide you. With Axios Pro Deals, you're going to be getting all of this industry-specific insight and expert analysis at a level you simply can't get anywhere else. So if you're a venture capitalist, private equity investor, banker, trader, founder, executive, anyone who cares about deals, Axios Pro is what you need to help you understand what matters and why. Start your free trial today at AxiosPro.com.
Welcome to another Dealmakers virtual event. This one is titled The Forecast for Capital Markets. I'm Kia Kokolacheva, a technology and business reporter at Axios, and I'm coming to you from San Francisco, California. Welcome to our audiences on Facebook, YouTube, Twitter, LinkedIn, and on Axios.com. Join the conversation today on Twitter with @Axios and hashtag Axios Events. For a final installment for 2022 Dealmakers series, I'll be joined today by my colleague Dan Primack, and we'll evaluate the factors shaping capital markets in 2023. And our first guest is the global head of capital markets at the New York Stock Exchange, Michael Harris, joining us from New York. Michael, hi.
Hey, Kia, how are you? Thanks for having me on.
Good. Thank you for being here. So we're just going to jump right in, and I'm going to ask you, when is the IPO window coming back?
Well, first of all, thanks again for having me on. I think that in answering that, it's really important to give some context to just where we are in terms of the market. So as we think back to 2021, obviously that was a period where we had, in many ways, just a record amount of support to the financial markets overall. You saw a record amount of monetary and also fiscal stimulus that resulted in a lot of support to a variety of asset classes, equities being a key part of that. And the IPO market was also the beneficiary. So as you looked at 2021, there were over 1,000 companies that went public, raising over $283 billion worth of proceeds. 2022 is a very different environment that we're in. There's a number of pressures that are at the forefront of investors' minds, most of them macro related, whether that's the inflationary environment, a rising rate environment, supply chain issues, tensions with China. There's a number of factors that are weighing on investors' minds. And as a result, you're seeing that reflected in terms of just the IPO issuance as well. So IPO proceeds have fallen pretty significantly as well. There's been about 160 companies that have come to the marketplace, raising a total of about $20 billion worth of capital. So a pretty significant fall off. So that's kind of the context. And as we kind of think about going forward and we think about what are the main things that both investors are going to be focused on and also issuers are focused on as well, when we talk to the companies that we work with, it really falls into three different lenses. On one hand, there's obviously a lot of the same macro issues that are going to be at the forefront of their minds. So the same types of issues in terms of inflationary risk, the same issues in terms of a rising rate environment that's causing a lot of uncertainty and also volatility that we're seeing reflected in the markets today. The second part of that is really, as you look at investors and what their focus is, it's going to be on what's happening from an investment performance standpoint. And within that, another piece of the pie is also just the performance within the equity capital markets area in terms of follow-on offerings. So for companies that they already own and they're actually entities raising capital, how those offerings perform, and ultimately their willingness for investors to put additional capital to work with companies that might be unproven. The last part of that is for companies that, to your point, as we think about going forward and new companies coming to the public markets, companies are able to really demonstrate a lot of visibility from an operational perspective. Companies that have very defensible business models, particularly as we look at a period of economic uncertainty. And then also from a balance sheet perspective, companies that are well positioned for a very uncertain time period going forward. Those are going to be the dynamics that are going to bode well for investors. And ultimately, that's going to be where issuers are going to be really focused on trying to explain their investment thesis to investors in the marketplace.
Right. So that narrative that we've been hearing about and seeing in a lot of the headlines about the return to profits, and that's the new investor focus. You think that's really going to be the case as we hopefully get some more IPOs going next year?
Yeah, I think profits are one part of it, but I think it really goes back to the idea of visibility. And I think the more that companies can demonstrate, whether that's from a cash flow perspective, from a top line or a bottom line perspective, I think it's more about being able to talk to the marketplace about visibility into their operations and the ability to actually demonstrate that over a very uncertain business cycle that their model can hold up. That's going to be the area that investors are going to focus on, and that's going to be the area that's ultimately going to be kind of the proof in the pudding, if you will, in terms of the success of those offerings in the marketplace.
You mentioned a huge gap in the proceeds and even in the number of actual listings between 2021 and this year. Do you think that 2021 was an outlier and that we shouldn't really be comparing everything going forward to those numbers?
Well, one thing that stands out in 2021 that was unique was the explosion in purpose acquisition companies. And that's an area where if you look at the actual amount of proceeds that were raised in 2021, roughly half of them came from those types of vehicles. And a combination of the performance of those companies in the aftermarket, the performance of those businesses as you look at how they performed post-business combination, and some of the regulatory headwinds are likely going to result in a lot of difficulties in terms of that asset class being successful in the IPO market. So I would expect that as we go into 2023 and beyond, we're likely going to be less proceeds coming in terms of the IPO market for SPACs. They're still going to be a relevant part of the asset class for IPOs, but not going to be nearly as large as what we saw in 2021 and also in 2020.
Speaking of SPACs, though, do you think that it's become maybe like a more popular route or vehicle than it was historically? Maybe obviously we won't go back to the pandemic era boom of the SPACs, but do you think it's something that's just become a little bit bigger than it has been historically?
Well, I think SPACs are always going to serve a piece and an option within the IPO market. And, here at the New York Stock Exchange, we've worked with a variety of companies that have looked at a number of different ways of going public. So whether that's through a SPAC offering, through direct listings, or through the traditional IPO process, I think the additional choice that issuers have in terms of going public, we think that's always a great thing. But I do think that in terms of just the overall pool, if you will, of availability, SPACs are likely going to be a smaller portion of that pool relative to traditional IPOs and also direct listings.
Mm-hmm. I'm sure at the New York Stock Exchange, you guys are constantly talking to companies that are considering an IPO, or maybe they're in the long process of preparing for one. What are you hearing about from them these days? What are they talking about? What are they asking you about? Are they considering maybe direct listings or anything else? Or is that out of fashion now because everyone wants to raise capital for a rainy day? What are the trends you're hearing from?
Yeah, as you'd expect, Kia, there's a pretty wide range of conversations. One thing that we love about this job, that I love about this job, is that you have the benefit of talking to just a wide range of companies, from a wide range of sectors and geographies. And one of the things that's pretty consistent in terms of what they're really focused on is the process around going public in terms of the timing and in terms of just how they think about the number of options that are out there. So to your point, direct listings are one area that is definitely under considerations. There are a few companies that we've been speaking with that are considering that process. The IPO process itself, the thing to always consider is that does take time. And that is an area where when you think about the time that management spends working with their advisors, with their legal counsel, with folks like ourselves, that's not something that they necessarily can just immediately turn on and execute. That is a months-long process. And so what we've always tried to advise issuers is to try to be prepared in that process and to have those conversations over a long period of time to make sure that as those market windows open, they're well prepared to be able to execute them when there's a viability and there's a good point of entry in the marketplace.
What's the profile of companies right now that's considering direct listings? I'm sure you don't want to name names, but are they just companies that are trying to be public because they've got some stock, some employee stock considerations, and they don't really need the cash? Like, what is the profile these days?
Yeah, I think the profile is pretty consistent with what we've seen with other issuers that have gone to the market via direct listing. Oftentimes, it's companies that don't necessarily need cash proceeds, but their existing stakeholders, those stakeholders sometimes being their employees, sometimes those are existing investors, want liquidity. And at the same time, you oftentimes will have management and their existing stakeholders that have an interest in being able to have a very democratic process to be public. And that means having a market-driven process for having both supply and demand meet in the market, have folks like our designated market makers assist in that process. And for us, we believe that it's a way of being able to democratize the process for going public. And so for some issuers who don't necessarily have a need to raise capital, but still seek a way to be to have the advantages of being a public company, it's a viable option. It's one that quite a few are considering right now.
Got it. I'm still waiting for a company to do a hybrid listing, with a primary capital raise and a direct listing, but I guess I'll have to wait a little bit longer. For the last few seconds, do you have a quick prediction for 2023?
Prediction is, I think it's really going to be market dependent, but we're very optimistic about the future, and we're very optimistic about all the issuers that we have the opportunity to work with here at the exchange. And it's a very diverse and a building pipeline, and we're excited about what the future holds.
Awesome. Well, thank you again for being here with us, Michael.
Thank you, Kia. Thanks for having me. I appreciate it.
Thanks, Kia. Thank you to our sponsor, Cooley, for making this conversation possible. I'm Fabrizio Drummond, Axios Chief Business Officer. I now have the pleasure of hosting a conversation with Christina Rupas, partner at Cooley. Christina, welcome to Axios.
Thank you so much for having me, Fabrizio.
Well, thank you for joining us. Let's start with the big picture. This year was a very challenging year for capital markets. What is, from your perspective, the current state of the market?
So to say it was a challenging year is a bit of an understatement. IPO proceeds were down almost 95% from last year. We had about 6.6 billion total in proceeds this year. And we had approximately 85 IPOs versus close to 400 at this time last year. So it was a very challenging year. At the same time, there are some interesting trends that we saw in 2022. One was that even 85 IPOs itself may sound like a lot to folks who've been watching the capital markets. And one of the trends has been microcap IPOs. So about 75% of the IPOs that actually got done this year had 50 million or less of proceeds. Another trend that we saw is that, healthcare and life sciences related IPOs really had an uptick, taking up about 50% of total proceeds for this year's IPO market, which is a pretty significant upsize from last year for that particular industry. And, look, we understand some of the reasons why the capital markets have reacted the way they did to recessionary fears and rising interest rates and inflation rates. But again, we do continue to see some positive signs. And in particular, we've seen over 250 follow-on offerings get done over the back half of this year. That's more than the first half of last year. And it continues to show us that there are companies that are able to access the markets, and there are investors willing to invest in these companies. So not all bad. We're starting to see some really positive signs.
And then zooming out and looking more from the upside, and as we look into 2023, what are some of the trends and industries that we should be watching for next year?
So I do believe we will continue to see the life sciences and biotech sector being able to successfully complete IPOs and follow-on offerings. But I certainly don't believe those are going to be the only deals we're seeing get done. A real focus of investors, particularly in this part of the market cycle, is going to be on, cash flow positive companies who are able to show, a track record of profitability. And so what that means is we might start to see the markets opening with companies in more traditional industries. Manufacturing, for instance, is an area where we do expect to see some transactions get done next year. That doesn't mean those are the only types of companies that will be successful in getting out, but from a market thawing perspective, I do believe those are going to be the types of companies that might be able to lead the pack. We don't see investors currently really looking for high risk, high reward types of companies. And that's a big change from prior years. But again, we expect to see the markets start to thaw with these types of deals. And then hopefully that opens the way for, in particular, tech to start to get some transactions done next year.
And then looking at alternative ways for going public, we watch over the last 2 years hundreds of SPACs be raised. What should we be thinking of SPACs right now?
Sure. So, SPACs are not dead. I tell my clients that all the time. There are, nearly 400 SPACs in the market right now that are looking for target companies. The number of SPAC IPOs is down pretty significantly, but for companies that in any other capital market cycle would be good candidates to access a traditional IPO path and just haven't been able to do that because the IPO market has been so soft this year, a de-SPAC could potentially be a good opportunity for them and a good way to become public. So, while I continue to expect to see SPAC IPOs decline even next year versus this year, I think we only had, it was a very limited number that was down this year, very significantly down. But at the same time, there are lots of lots of SPACs that are actively looking for targets and basically have through 2023 to get a business combination done or give money back to investors. So, there's pressure. No SPAC founder wants to have to, give money back. And so we do think there potentially could be some attractive opportunities. And we've recently seen, for instance, the Grindr de-SPAC transaction that was announced a couple of weeks ago has traded extraordinarily well in initial trading, up even more than 200% on the very first day. So I do think that will continue to be a viable option. And we may see direct listings get done. Again, we haven't seen a lot of those, but for companies that don't have immediate liquidity needs, but are, they don't need to raise capital themselves, but are looking to get liquidity to their investors, that could also potentially be a viable alternative approach.
Excellent. And lastly, if I'm a CEO taking a company public, what is the one best piece of advice that you can leave our audience with as we head into next year in the context of going public?
So, a lot of CEOs were successful in raising private capital in 2021 and 2022 at, valuations they were comfortable with. And what that has done is taken some of the pressure off. This was not a great IPO year, but companies didn't necessarily need to get in the market in the way that they would have had they not been able to raise that private capital. So now the name of the game is there's going to start being pressure from investors. There's hope that there will be a market window that comes next year. And how do we be ready to access that window when and if it appears, and to be as nimble as possible? So my best piece of advice is start getting ready now is really, I think, the name of the game. An IPO process from start to finish, from org meeting to actually listing, is typically 6 months. And this is not a typical market. So it has taken much longer for companies. And even that timeline doesn't really encompass the getting ready period, all the behind the scenes preparation that happens before that initial org meeting. So as I talk to, CEOs and founders that are thinking about wanting to get out at any point in 2023, or frankly, even thinking, early 2024 is when they really need to get a deal done, my answer is start now. Start to get ready, start to talk to lawyers and bankers and run your process behind the scenes so that, again, when that window comes, you can be very nimble and access that window in a, sort of a thoughtful way. So I guess in sum, be prepared.
Excellent. Christina, thank you for joining us and for such an insightful conversation.
Thanks so much for having me.
Hi, I'm Dan Primack, business editor at Axios, and our final guest this afternoon is Jay Doss, who is the co-founder, president, and partner with Sapphire Ventures, joining us from Menlo Park, California. Hey, Jay.
Thanks for having me, Dan. Glad to be here.
So Jay, the kind of operative word, particularly in the growth equity market where Sapphire spends a lot of its time lately, has been, I guess, deceleration or just kind of emptiness. Do you expect the current slowdown to play into 2023?
Yes, this year has been kind of the number of deals people have been doing in the early growth space or where we play has been very minimal, right? We do think that in 2023, things will open up a little bit. First and foremost, I think a lot of CEOs and founders will have come to the realization that maybe they should take some capital at a valuation and multiples that were, not similar to what public market companies are trading at. And second, I think, there's so much money sitting on the sideline that people will start making investments. So yeah, I do think in the first half, you will see more investments happening in the growth space.
It sounds like what you're almost saying is each side is trying to wait the other one out. You've got the founders and the entrepreneurs who are saying, well, look, these VC firms raised a ton of money. They've got to put it to work. And then you got the VC firms looking at the entrepreneurs and their kind of run rate and saying, well, at some point they're going to have to raise cash and they'll suck up the down round because they're going to need it. Who blinks first?
I think the entrepreneurs who are running out of cash is probably going to blink first. They're going to, say that, look, and there's opportunities for me out there. And a lot of the boards are trying to tell their CEOs and their management teams, is like, look, if you want to grow and, even if you get diluted a little bit more because your valuation goes down, on the other hand, the pie gets bigger because you can, acquire other companies. You can maybe get more talent at this time, because there's a lot of talent looking for a home, given all the cost cutting that's going on. So you can play offense and, ultimately the pie gets bigger, right? And so I think boards are starting to have these conversations with their CEOs that, look, it might not be a bad idea to take some equity, even though it might be at a lower valuation than your last round.
There is a perception, I think actually it's past perception, I think it's probably reality, that there is an enormous amount of capital, as you said, sitting on the sideline, dry powder in venture capital, growth equity, kind of buyout funds that also are playing in this growth stage. This week, for example, Fanatics raises money from Clearlake, which is essentially a buyout fund, but they come into the startup market. When we last saw a significant downturn in venture capital, like significant in the .com crash, and I know this is different, VC funds gave back capital limited partners, committed capital, and said, you know what? We raised this when the market was up here. The market's now down here. We can't reasonably invest this much money. Haven't seen that at all right now. Why not?
Yeah. Yes. No, by the way, I lived through that .com period too, Dan. And I think what has happened is that funds have raised their latest funds really, really quickly, right? It went from raising a new fund every 3 years to 24 months to 12 months, right? And I think the LPs are telling their GPs that, look, we are not going to ask you to cut down on your commitments, but you should scale back on the way that you're investing the capital, right? So before, when GPs are thinking of investing whatever they had raised in, say, 12 to 18 months, now their LPs are telling them it's okay that you take 36 months to deploy the capital, and we are fine with it. And it's actually beneficial for us, right? Because the LPs are not getting back any distributions either. So in that way, although capital is not being given back, in some ways, the LPs are asking the GPs to stretch it out, and which kind of mathematically comes to the same place, right? That you're committing less capital, even though the amount of raised capital is a large amount that's sitting on the sideline.
I'm curious, are LPs asking you, or you maybe just proactively providing LPs with more information about existing portfolio companies and their health so that LPs can get a better sense of what they actually have already in the ground, maybe more than they would have wanted or needed a year or two ago?
Yes, absolutely. I think, GPs have become much more proactive in talking to the LPs, giving them a health of their portfolio companies, telling them how the portfolio companies are doing, because now they have realized that it's not in a, kind of a seller's market anymore, right? So they really have to make sure that the LPs that they have are happy, because everybody has to at some point go back and tell their LPs that, hey, we have to take a write down, right? Like every firm is different, and they have private companies in how they take write downs. But every portfolio, given that the valuations of public markets are down 60-70%, is down significantly. So I think the GPs are all proactively going to the LPs and telling them this is really the worth of the portfolio, and also talking about how they can, when the exits will happen, when the company that were supposed to go public maybe a year ago, 2 years ago, when they will actually go now, given the state of the public market. So yeah, I think GPs are being much more proactive with LPs now.
The IPO market is essentially dead right now. The US IPO market is essentially dead right now. Do you expect the IPO window to reopen at some point in 2023 for tech companies?
Yeah, I definitely think in the second half of next year, because I think, if you look at it, there will be companies which are 200, 300 million in revenue, growing at 40-50%. And there's a fair number of them out there. And I think they will also have had a year and a half to really get their metrics in line, because what the public market is really looking for is companies that are growing at greater than 35%, and almost close to cash flow break even, right? The rule of 40 plays a big role nowadays. So I think there are companies who are kind of focused on getting to those metrics. And I think there will be also an appetite by probably second half of next year, when we know more about how the economy is doing, what the kind of going forward Fed rate is, right? Which is like a big kind of factor which is going to play in when the markets open up. But yeah, I hope that the market opens by second half of 2023.
I'm curious, if it doesn't, what's the contingencies? You've got a lot of companies that have raised an enormous, particularly in the growth stage, have raised an enormous amount of money, really kind of a pre-IPO round 12 months ago. I mean, do we see a shakeout with a lot of big scale M&A, or do we not? Because the big acquirers, their stock value is lower, so that they've got less buying power than they used to have.
So I do think a lot of companies will end up selling to PE firms, right? Just like Clearlake did, Thoma Bravo, Vista all have large funds that are sitting out there. Some of them will acquire, do roll-up plays. So I think the PE firms will be much more active next year. And I also think the strategics will come back into play. Particularly, I think the stock price has been an issue, but also the strategics are also worried about regulatory kind of issues, right? Because every time any acquisition gets done, there's a lot of kind of looking into what's going on, whether it's an issue with the DOJ, Department of Justice. So I think people are still wary of that. But at some point, if they get no clarity about how the Department of Justice or antitrust is going to look at acquisitions, they will probably get much more acquisitive. So I definitely think that the large strategics will start acquiring next year.
You also mentioned those big private equity firms like Clearlake, Thoma Bravo, et cetera. Do you expect those firms to continue being active also in the startup scene, or do you see them going back and kind of returning to their knitting almost exclusively?
Yeah, I definitely think that they're going to go back to their knitting, right? Because, at some point, investing, say, 100 million into and not having control over a company is nothing versus, deploying like 2 billion into a company which they can take control. They can, cost reduce, they can dividend out, by taking some debt onto the balance sheet. You really can't do all of these things when you are, one among other 10 other investors, right? So
Yeah.
I do think that they will, kind of retreat from trying to do more venture-owned debt or venture kind of investments and really focus on doing what they know really well, which is take companies private or, take late-stage companies and own them. And, I think Vista did with Drift, right? Which was, I think, happened last year. So you'll see more of those happening for sure.
So Jay, final question for you. The history of venture capital is that when the market is bad, that is often when the best investments are made. When the market is very hot, it's often when the worst investments are made. So do you believe Sapphire's 2021 vintage deals will be better or worse performing in the end than its 2023 vintage deals?
Going by what I've seen, 2023 will probably be a better vintage year than 2021, for sure. But that's hopefully it's not terrible, but I think everybody's funds for 2021 will kind of have bad returns compared to their 2023 funds.
Jay Das, thank you so much for joining us.
Thanks, Dan.
Thank you for joining us this afternoon for another Axios Dealmakers event, which has made us all smarter faster. To sign up for the Axios Pro Rata newsletter or any of our newsletters, please go to axios.com/newsletters or use the Axios app. And to access our exclusive subscriber-only information for deal professionals who want deeper reporting and analysis, please subscribe to Axios Pro at axiospro.com. Thanks again for joining, and we will see you at axios.com.